The master budget, an operating budget's example. Do you ever feel like a really good cup of coffee? Well, imagine a business that's taking coffee quite seriously, and they have two very popular blends of coffee that they sell to roasters around the world. The first will be on the left. They call this specialty blend the Real Nice blend of coffee, abbreviated as RN1 as their internal code. This particular coffee contains two specialty beans. Because I'm an accountant, we'll just call it Direct Material 1 and Direct Material 3. You might be wondering, where's Direct Material 2? They use that in their second, more expensive blend of coffee on the right. That particular specialty blend is called DaBomb, or DB1 for short. This takes three different types of beans: Direct Material 1, Direct Material 3, and it's a more complete flavor profile, so this also includes Direct Material 2. In this video, we're going to take a look at all of the operating budgets that this business uses to budget their operations for a fiscal period. Let's go. Here we are looking at some information for the Counting Beans Company. Let's say they make two types of specialty blends of beans that are sent out to roasters all around the world. The first type of blend is called Real Nice, or abbreviated here as the RN1 blend. And over on the right, we have DaBomb, or the DB1 blend. Each specialty blend uses its own unique combination of beans sourced from different parts of the world. So we've got Direct Material 1, which is a very specific type of bean, and the Real Nice product requires 10 pounds of it. The DaBomb product requires 8 pounds of it. The next bean is Direct Material 2, or the second type of bean. There's none required for the Real Nice product. There are 4 pounds required for the DB1 product. And then we have the third type of bean, Direct Material 3. 2 pounds are required for every unit of RN1, and only 1 pound is required for each 1 unit of the DB1 product. Direct labor is also required. RN1 requires 2 hours of direct labor, whereas DB1 requires 3 hours of direct labor. These are specialty blends. They are not cheap, so they are sold for a fair price. The price for this is $150 per unit for every unit of RN1 and $220 a unit for every unit of DB1. Sales for RN1 with the lower price, you can expect a higher number of sales, 12,000 units, and for DB1, 9,000 units. The business estimates that beginning inventory for the period will be 400 units of RN1 and 150 units for DB1. And they desire 300 units in ending inventory for the RN1 product and 200 units of ending inventory for the DB1 product. Now, we still need some more information. We are given a cost per pound. Remember, there are 3 types of specialty beans that go into each one of these blends. We're just calling them Direct Material 1, 2, and 3. And the cost per pound is $2 for Direct Material 1 per pound, $2.50 per pound for Direct Material 2, and only 50 cents per pound for Direct Material 3. They have beginning and desired ending inventory for each of these. They estimate that they will begin with 3,000 pounds of inventory for Direct Material 1, 1,500 pounds of inventory for Direct Material 2, and 1,000 pounds of beginning inventory for Direct Material 3. The desired ending inventory is also given to us. We have the ending inventory in pounds is 4,000 for Direct Material 1, 1,000 for Direct Material 2, and 1,500 pounds for Direct Material 3. Some other data that is important is provided to us. We are told here that the firm expects the average wage rate to be $25 per hour. They use direct labor hours to apply overhead. Each year, the firm determines the overhead application rate for the year based on the budgeted amount of output for the year. The company maintains negligible, that means near zero, work in process inventory, and they expect the cost per unit for both beginning and ending finished products inventories to be identical. So costs are relatively stable throughout the year. We're then given some more information, and I'll scroll down so we could see that. We are told some things about manufacturing overhead. We are given a number of different line items that total $580,830. And you'll note that some of these items are variable, whereas others might be fixed, and you need to keep track of that. Then we are given some selling and administrative expense information. Again, these now are summed up here and they are totaled to be 645,000. And we are finally given an estimated tax rate of 40%. We are now required to do the following things. We're asked to prepare the following schedules or statements based on the data provided. We are asked here to prepare a sales budget, then a production budget, then the direct materials budget in units and dollars, the direct labor budget, the manufacturing overhead budget, the cost of goods sold and ending inventory budgets, selling and administrative expense budget, and the budgeted income statement. And we'll end with after-tax operating income since we have an estimate for corporate taxes. Now, I've just pasted something here that on the right that you might find useful. As a reminder from a prior lesson, we start with our sales budget. And once we have some idea of ending inventory, which we do, it was given in this question, we can determine production. That will help us determine what our direct materials, direct labor, and manufacturing overhead should be. Then we can calculate the cost of goods sold, and that will lead us to our income statement. Let's get to it. So our sales were given to us as being $12,000 and $9,000. Where did I get that? I got that information from way up top, our product information here. We are told that sales is estimated to be $12,000 and $9,000. We are given our sales price per unit, and so we could use that data down below. And now that we're back here, we could see 12,000 times 150 is $1.8 million. 9,000 times 220 a unit is $1,980,000 for a total of $3,780,000. So now that we are done sales, we can go ahead and do production, provided we have some information about ending inventory. And again, we do. If we go back up to our product information, we are told what the desired ending inventory is for each product, 300 units and 200 units. So taking a look at our production budget, we can take our sales, which was given, and then add the desired ending inventory for each product, and we get the total amount of inventory that is needed. If we subtract what the business expects to have, 400 units and 150, which again was given, we can then calculate the amount that needs to be produced. 12,300 subtract 400 is 11,900 units, or 9,200 subtract 150 is 9,050 units. Once we have the amount that needs to be produced, again, if we have the amount of production, we could start to calculate our direct materials budget, our direct labor budget, and manufacturing overhead. To do direct materials, we can come down to our direct materials budget, and you can see that we'll have one schedule per each material. So for direct material 1, we'll say the number of total units to be produced for product 1, for product RN1 and DB1 is 11,900 and 9,050. That was taken from the schedule before. And then we multiply that by the number of pounds required to make an RN1 or a DB1. This is 10 pounds and 8 pounds for the first type of specialty bean, direct material 1. Again, if you cannot remember where the pounds per unit comes from, I'll scroll back to the top. And we can see here that for RN1 and DB1, we know that we require 10 pounds and 8 pounds. We also have the information for direct material 2, which will be 4 pounds for DB1, and for direct material 3, it'll be 2 pounds versus 1 pound. So if we take a look at our direct materials purchase budget for direct material 1, we could see that we need direct material 1 to be used in production is a total of 191,400 pounds. We just need the total number of pounds. We don't need the total exactly split up by RN1 and DB1. You could think of a business that's making donuts and making cake. At some point, they just need to determine how much flour do they need in total. And that's what we're doing here. How much of the specialty bean direct material 1 do we need in total? To satisfy production, we need 191,400 pounds. The business also desired to have ending inventory of 4,000 pounds, which means the pounds needed in total for the period is 195,400 pounds. However, they expect to have 3,000 pounds at the beginning of the period. So 195,400 subtract 3,000 equals 192,400 pounds multiplied by the cost per pound which was given to us, and we get the budgeted purchase cost of direct material 1 is $384,800. We could do the same thing for direct material 2. Remember, the amount of units to produce is 11,900 and 9,050. We got those numbers from our production budget up above. And the pounds required of direct material 2 to make the real nice product is 0. None of this bean goes into RN1. However, 4 pounds of this specialty bean does go into DB1, which means we get 36,200 pounds needed of direct material 2 to satisfy all production. Then the business wants 1,000 pounds left over at the end of the period, which means the total amount needed is 37,200 pounds. But they expect to have 1,500 pounds already at the beginning of the period, which means they have to purchase the difference, which is 35,700 pounds, multiplied by $2.50, which works out to $89,250. Then we can do the same thing for direct material 3. Again, the number of units that are being produced has not changed. The pounds per unit is different though, because direct material 3, 2 pounds are needed to make every unit of RN1, and 1 pound is needed to make every unit of DB1. If we multiply it, we get 11,900 times 2 equals 23,800. 9,050 times 1 is 9,050. And if we add this up, we get $32,850. If we add the desired ending inventory, we need a total of 34,350 pounds for the period. Subtract the estimated beginning inventory of 1,000 pounds, and the business has to purchase 33,350 pounds, multiplied by a purchase price of 50 cents per pound, and they get $16,675 in order to purchase all of the pounds they need for direct material 3. We can now move on to the direct labor budget. Let's do that. For direct labor, we are still considering the number of units that have to be produced. Both of these numbers come from the production budget. It was 2 hours per unit to make one RN1 product, which works out to 23,800 hours. 9,050 units multiplied by 3 hours equals 27,150 for a total of 50,950 hours. Multiplied by $25 an hour, and we get a budgeted direct labor cost of $1,273,700 $750. Then we were given a number of different overhead items, and it's good if you know which overhead items are variable and which are fixed just to organize them together. But all this is a copy and paste of the numbers given earlier. Variable overhead equals 326.80 and fixed overhead equals 254,750. If we take 326 and 80 and we add it to 254,750, we get a total of $580,830 in overhead. Now we can start to cost things out in a bit more detail. Remember, this business is going to allocate overhead based on the number of direct labor hours. So I'll actually scroll down where we can do some of this. We'll begin by taking a look at Schedule 2 down here. We can see that if we want to calculate a cost per unit, we could do that. We could say that direct material 1 is $2 a unit, direct material 2 is $2.50 a unit, and direct material 3 is 50 cents a unit. We can multiply that by the 8 pounds needed for direct material 1, which works out to $16 per unit. The 4 pounds needed of direct material 2, if we do the math, we end up with $10 total per unit. And for direct material 3, we get 50 cents per unit. The direct labor is $25 multiplied by 3 hours, or $75 per unit of DB1. And then we get to the overhead. So we can take our overhead amount and divide it by the number of direct labor hours. Remember, the direct labor hours we calculated earlier. It was 50,950 hours. This gives us $6.40 in variable overhead per direct labor hour. And remember, it's 3 direct labor hours to make DB1. That's $19.20. For fixed overhead, it would be $5 per direct labor hour multiplied by 3 direct labor hours. That gives us $15 for a total cost per unit of $135.70. We can then, when we are calculating our cost of goods sold, we can say that the business expects to sell 9,000 units of DB1 multiplied by 135.70. The cost of goods sold for this product is $1,221,300. If we do the same thing for the first product, Real Nice RN1, we can see that we once again have our unit input costs. So $2 per pound of direct material 1. This product does not use direct material 2, so we'll go straight to direct material 3. It's 50 cents times 2 pounds, which is $1. The direct labor is still $25 an hour times 2 hours, which is $50. And then our variable factory overhead or our fixed factory overhead, the rates are the same as we calculated earlier, except now we are multiplying by only 2 direct labor hours for $12.80 and $10. If we sum all of this up, it equals $93.80. Meaning up here, if we have 12,000 units in sales volume multiplied by $93.80, the cost of goods sold would be $1,125,600. Added up, we get $2,346,900. We were also given ending finished good or desired ending finished goods. We can multiply those by the cost per unit as well if you wanted to determine an ending finished goods inventory value. Now, we were given the selling and administrative expenses earlier on in the question. So if we just take all of that together, we have $325,000 in selling expenses, $320,000 in admin expenses for a total of $645,000 in selling and administrative expenses. We can now come up with a quick budgeted income statement for the year. We would take our sales from our sales budget, which equaled $3,780,000. Our cost of goods sold from our cost of goods sold budget, which was $2,346,900. Then we could have a gross profit on a product by product basis. If we subtract our selling and admin expenses, we get pre-tax operating income of $788,100. Multiply this by 40%, and then after-tax operating income, or 60%, what's left over is $472,860. I hope you found that helpful. Until next time, I'll say thank you for watching, and may your journey be joyful.
Yo, gather round, let me spill the beans about a coffee crew living the caffeine dreams. Counting Beans Company, that's the team. Master budgeting is our ultimate scheme. We mix it up, blend so nice. Operating budgets, we don't think twice. From sales to profit, watch us grow. Master budgeting, that's the flow. First up, we got that real nice blend. RN1's the code, let the flavor extend. 10 pounds of bean 1, that's the base. 2 pounds of bean 3 around the taste. On the flip side, here comes the bomb. DB1's the name, flavor so strong. 8 pounds of bean 1, 4 pounds of 2, 1 pound of 3, that's how we brew. We mix it up, blend so nice. Operating budgets, we don't think twice. From sales to profit, watch us grow. Master budgeting, that's the flow. 12,000 units of real nice sold at $1.50 each, watch the cash unfold. 9,000 bombs at $2.20 a pop. Our sales budget set, and we won't stop. Add desired inventory to the mix. Subtract the beginning, do the budget tricks. Production numbers now in sight. Let's get those beans roasted right. Materials needed, let's break it down. Direct materials all around. DM1, we need a heat. Pounds on pounds, no time to sleep. Direct labor's next, hours on the clock. 50,000 strong, we can't be stopped. At 25 an hour, our team's on fire. Grinding so hard, they never tire. Overhead applied on labor hours. Variable fixed, we've got the power. Summing it up, the totals rise. Master budgeting opens our eyes. We mix it up, blend so nice. Operating budgets, we don't think twice. From sales to profit, watch us grow. Master budgeting, that's the flow. Cost of goods sold, we calculate. Subtract from sales, gross profits, great. Selling and admin, 645 grand. Expenses tallied, just as planned. 40% taxes, they take the share. But profits remain, and we're aware. Net income shining at day's end. Counting Beans Company sets the trend. From beans to blends, we've shown you how. Master budgeting's the game, take a bow. Operating budgets, we made it fun. Now go through success, cause we're all done. We mix it up, blend so nice. Operating budgets, we don't think twice. From sales to profit, watch us grow. Master budgeting, that's the flow.